The U.S. government tried to drag the guy who controls your mortgage rate into court over a building renovation. A federal judge took one look at the case, said, quote, "You have zero evidence of a crime," and threw it out. And this turned out to be the best thing that happened to your wallet this year. Imagine you hire a financial advisor, smart guy, keeps your spending in check, stops you from blowing your paycheck on a boat you don't need. Now imagine your loudest friend grabs your advisor by the collar and says, "Tell him he can afford the boat, or I'll get you fired." That's essentially what just happened between the White House, the Department of Justice, and the Federal Reserve, except the boat is the entire American economy, and the friend is holding a subpoena instead of a beer. So let's talk about why a judge just stepped in, why Wall Street collectively exhaled, and why this courtroom drama might affect your credit card bill more than any election ad ever could. Here's the ultra-simple version. The Federal Reserve is America's money thermostat. Too hot? They raise interest rates to cool things down. Too cold? They lower rates to warm things up. The whole system only works if nobody gets to override the thermostat for political reasons. The president can yell at the thermostat all he wants. He can tweet about the thermostat. He can call the thermostat names on live television. But he cannot walk over and crank it to whatever temperature wins him votes. That's been the deal since 1913. And for over a century, with a few ugly exceptions we'll get to, it's worked. But in early 2026, the Trump administration decided to test that deal, and this turned out to be a terrible idea. Let's set the scene. It's late 2025. Inflation has been cooling, but it's still sticky, hovering around 3%. The Fed under Jerome Powell is keeping interest rates elevated. Powell's logic is straightforward. Cut too early, and inflation roars back. The White House sees it differently. Higher rates mean more expensive mortgages, pricier car loans, and businesses that are slower to hire. That's bad optics, so the pressure campaign begins. Public statements calling Powell too slow, social media posts suggesting he should be replaced. And then, in January 2026, the Department of Justice takes it up a notch. They issue a subpoena to Jerome Powell. Not about monetary policy directly. Oh no, that would be too obvious. The official reason? A renovation project at the Federal Reserve's headquarters building. The allegation that Powell may have misled Congress about the costs? Yes, you heard that right. A building renovation. But little did the DOJ know, the judge assigned to this case was about to see right through it. To understand why the White House wanted Powell to cut rates so badly, you need to understand how intoxicating cheap money is. When the Fed lowers interest rates, it's like opening the bar tab for the entire economy. Businesses borrow more. Consumers spend more. Housing prices go up, which makes homeowners feel rich. Stock markets rally, which makes investors feel genius. Everyone's happy. Politicians look brilliant. It's an economic sugar rush. And who doesn't love sugar? Between 2020 and 2022, rates were near zero. The economy was flooded with cheap money. Home prices surged roughly 40% in many markets. The S&P 500 nearly doubled. Crypto went to the moon. Your neighbor who couldn't spell portfolio was suddenly giving you stock tips. And this turned out to be a terrible idea, because all that cheap money had a cost. Inflation exploded to over 9% by mid-2022, the highest in 4 decades. Groceries, gas, rent, everything spiked. The sugar rush became a sugar crash. And the Fed, under Powell, had to slam the brakes. Rates went from near zero to over 5% in less than 2 years. The fastest tightening cycle in modern history. Mortgages doubled. Credit card rates hit record highs. And suddenly nobody was giving stock tips at barbecues anymore. But here's the thing. It worked. Inflation started coming down. Slowly, painfully, but it came down. Powell held the line, and that's exactly what made him a target. So the subpoena lands. January 2026. The DOJ says it's investigating whether Powell misrepresented costs of the Fed headquarters. Renovation to Congress. On paper, it sounds like a routine oversight matter. A little accounting dispute. Nothing to see here. Except, well, everything about it was suspicious. First, the timing. The subpoena arrived just weeks after Powell publicly stated the Fed would not be rushing to cut rates in 2026. Coincidence? The judge didn't think so. Second, the evidence. Or rather, the complete absence of evidence. When the case reached Judge James Boasberg, the Chief Judge of the U.S. District Court in Washington, D.C., he asked the DOJ a simple question: what crime are you actually investigating? The DOJ's answer was, let's say, underwhelming. They couldn't point to a single piece of evidence that Powell had committed perjury or any other crime. Not one document, not one witness, not one email. Judge Boasberg, in his ruling on March 13, 2026, didn't mince words. He called the subpoena a, quote, pretext, a fancy legal word for excuse. He said the real purpose was to pressure Powell into cutting rates, or to intimidate him into resigning. The judge essentially said, you brought a legal weapon to a political fight, and I'm not playing along. Now, the DOJ has announced it will appeal. So this fight isn't over. But the message from the judiciary was loud and clear. The courts will not be used as a tool to bully the Federal Reserve. And here's where it gets wild. Meanwhile, on Wall Street, traders were watching this case like it was the Super Bowl. Because here's what most people don't realize. Financial markets don't just react to interest rate decisions. They react to the expectation of future decisions. And if the market believed the Fed's independence was compromised, that Powell could be bullied into cutting rates for political reasons, it would trigger chaos. Bond yields would spike, because investors would demand higher returns to compensate for the risk of politically driven inflation. The dollar could weaken. Foreign investors might start pulling money out of U.S. Treasuries. The moment Boasberg's ruling dropped, bond markets stabilized. The 10-year Treasury yield, which had been climbing on uncertainty, eased back. Wall Street read the ruling as a signal. The adults are still in charge. Meanwhile, in Washington, the political machinery kept grinding. The DOJ announced its appeal. Congressional allies of the administration called the judge activist. The rhetoric escalated. But behind closed doors, legal experts on both sides acknowledged the ruling was on solid constitutional ground. The separation of powers isn't a suggestion. It's the architecture. Meanwhile, at kitchen tables across America, a family in Ohio was calculating whether they could afford to refinance their mortgage. A small business owner in Texas was deciding whether to hire 2 new employees or wait. A recent graduate in California was staring at a credit card statement with a 22% APR, wondering how it got so high. None of them were watching C-SPAN, but every single one of them was living inside the consequences of this fight. And this turned out to be a terrible idea. The idea that any of this was just politics as usual. Here's the part that actually matters. Let's trace the money chain from this courtroom all the way to your wallet. Step 1. The Fed sets the federal funds rate. That's the rate banks charge each other overnight. Right now, it's sitting between 4.5% and 4.75%. Step 2. That rate ripples outward. Banks use it to set the prime rate, which is currently around 8%. Step 3. Your credit card company takes the prime rate and adds a margin. That's why your credit card APR is somewhere between 20 and 25% right now. If you're carrying a $5,000 balance, you're paying roughly $1,000 a year just in interest. Step 4. Mortgage rates. The 30-year fixed mortgage tracks the 10-year Treasury yield, which is influenced by Fed policy and inflation expectations. Right now, mortgages are hovering near 6.5%. On a $400,000 home, that's about $2,500 a month. If rates were 2 points lower, you'd save over $500 monthly. Step 5. Jobs. When borrowing is expensive, companies delay expansion. They freeze hiring, they cut costs. The unemployment rate has been ticking up, and every fraction of a percent represents real people losing real paychecks. So when someone tells you this Fed subpoena story is just Washington drama, look them in the eye. and say this is a fight over who controls the price of your money. And if the wrong side wins, you pay. Literally. So what's the lesson? It's painfully simple. Central bank independence isn't some abstract principle for economics professors to argue about over coffee. It's the firewall between your savings and political ambition. Every time that firewall has been breached in history, from Nixon pressuring Arthur Burns in the 70s to Turkey's Erdogan firing central bankers who wouldn't cut rates, the result has been the same. Inflation spirals, currencies crash, and ordinary people get crushed. Judge Boasberg reinforced that firewall on March 13th. But the DOJ is appealing. The political pressure isn't going away. And if history teaches us anything, it's that this exact fight will happen again, because the temptation to control the money thermostat is just too strong. And humans, well, we never learn, which of course turned out to be a terrible idea. If this video helped you understand why a courtroom ruling about a building renovation might be the most important financial story of the year, hit that subscribe button. We track the money so you don't have to. Drop a comment. Do you think the Fed will hold the line, or will political pressure eventually win? And share this with someone who thinks interest rates are boring. They're not. They're the most expensive thing you're not paying attention to. See you in the next one.